Everyone keeps asking, what's the best ETF in Switzerland? Is it S&P 500 or a world ETF or Swiss ETF? Just tell me the name, I will buy it. It sounds very familiar, right? So in today's video, I will show you how to find the best ETF for you, not just the popular ones online. And we'll cover the key criteria that actually matter and how I built my own ETF portfolio and one mistake ETF investors make that cost them millions. And by the end of this video, you will know exactly what to do next. Hey, I'm Charlene. I'm your investment coach based here in Zurich, Switzerland. And this is the channel where I share my 10 plus years of banking and investing experience with you all for free. Like and subscribe for more videos like this. And now let's start with the basics. So what is an ETF? So ETF stands for Exchange Traded Fund. So sounds very complicated, right? But it's actually very, very simple. So basically an ETF is like a chocolate box. So inside that box, many investments. You have stocks, sometimes bonds, sometimes both. So instead of buying one company, you buy many companies at once. For example, one of the most popular ones, you buy the S&P 500 ETF, and means the biggest 500 companies in the US, and you instantly basically own a small piece of the total 500, the biggest companies actually in the United States. So for example, Apple, Amazon, Microsoft, and many, many more. So all in one trade. And most people, they like ETF because they like first, they like diversification, two, they like low cost, and three, they're really simple. And of course, ETFs are not perfect. There are downsides as well. For example, you will not beat the market, you are not going to control any individual companies as well. But in this video, we're not diving deep into ETF pros and cons instead. And today is about how to choose the best ETF for you. So now let's talk about 5 key criteria that makes a good ETF. Basically, based on what you choose them, right? So not all ETFs are created equal. So basically 2 ETFs can look very similar, but long term, the difference really matter. And basically here are the 5 criteria I personally focus on. So the first one is about index quality. So this is really the foundation, and it's where most people get it wrong. So ETF is just a wrapper. My friend, it's just like a box, like I mentioned, like a chocolate box. So what really matters is the index underneath. It's like what matters are those chocolates inside those chocolate box instead of the box itself. So does it make sense? So before asking, okay, is this a good ETF? You should ask, does this index fit my financial situation and my financial goals? So this is exactly how I teach, for example, investing inside my signature course, Vision Investment Academy. So for example, a long-term goal like retirement in 25 to 30 years, a broad global equity index can make a lot of sense. A medium-term goal like buying property for 5 to 7 years, the same index might be a little bit too volatile. When I talk about an index, it's the foundation. So index quality is not about, okay, what is popular. It's about what fits you. And now when it comes to quality itself, me personally, I would say I prefer indices that are 1, well-established, 2, rules-based, 3, transparent, 4, boring. Sometimes boring, simple really is the best. So indices like S&P 500, MSCI World, and etc. MSCI Europe, MSCI Asia, emerging market. So they are not exciting, but they are predictable. And predictability matters when you're investing for the long term. So for example, if an index is overly complex, changes rules all the time, or promises to beat the market, that's really a warning sign. So because in long-term investing, simplicity survives. So my friends, this concludes the first criteria when choosing an ETF, the underlying index. So choose an ETF with an index that reflects your financial situation, your time horizon, and your investment goals, because the right index is really the foundation of a good investment strategy. Now let's talk about the second criteria. So fees matter more than people think. So when choosing ETF, actually the industry often use an indicator called TER. It stands for total expense ratio. And the TER is basically the annual fee you pay to have this ETF. And every year, no matter what. So 0.2% might sound okay, tiny, but over 30 years, it can eat a big chunk of your returns. So for core ETFs, I would say look for something below 0.2%, below 0.1 is even better. The lower the better, basically, right? If all the other areas are the same. And high fees here, it doesn't really mean higher returns. They just mean more money for the fund provider. And now let's talk about the third one, size. So size is really, I would say, quiet, but it's a very important factor. So a good ETF should have a decent amount of assets under management. So AUM, the industry calls it assets under management, AUM, okay? It's an abbreviation. So ideally, hundreds of millions, or even better, billions. You know, some people will tell you, oh, the bigger the better. So why does this matter? And large ETFs usually mean better liquidity, tighter bid and ask spreads, and lower trading costs. So Charlene, you're overwhelming me. So what does that actually mean? Let me explain it to you. So liquidity means how easy it is for you to buy and sell. So a large ETF has many buyers and sellers. So when you want to trade, when you want to buy or sell, someone is always on the other side. And bid-ask spread is the gap between the price you can buy and the price you can sell. And in a large ETF, that gap is really tiny and maybe just a few cents. But a smaller ETF or a really small ETF, that gap can be much, much bigger because no one, it's not popular, no one wants to buy it. So that difference, that's a hidden cost you pay every time you trade. So larger ETFs usually mean you get in easier, you get out easier, and you lose less money in between. So that's why, if all else equal, I prefer bigger, well-established ETFs. And some small ETFs, can be really risky. They may be expensive to trade, or worse, maybe one day they can be shut down. The next criteria I'm going to talk about is domicile. So ETF domicile simply means, where the ETF is actually based. So common ones you will see as a Swiss investor is like US domicile ETFs or airline domicile ETFs. And here's the key point. Actually, there's no universally best domicile. So it depends on what you invest in and what you want to optimize. So let me give you some examples. So US domicile ETFs. So they are very popular, especially for US exposure. And the pros are they are very low fees and excellent liquidity. And now you know what is liquidity, right? And very efficient for US stocks, and withholding tax on US dividends can usually be reclaimed in Switzerland as well. And there are some cons as well, like for example, people will claim that more tax leakage for global exposure. And for airline domicile ETFs, there are also pros and cons. I would say they're common for global portfolios. If you do some research online, you can also find people say they have best tax treatment for non-US stocks, less dividend tax leakage, inside the fund, or often preferred for a global or all-world exposure. But there are some cons as well. Usually they have higher fees, they have slightly higher TER, size is smaller than the US one usually, and the size also means tighter or higher liquidity risk. So the key takeaway for Domicile, in my personal opinion, is that ETF Domicile is not all about, right or wrong, go with this instead of that. So it's about fit, basically. So I see some people, they claim online, okay, US Domicile ETFs, that can be great for US focused funds or US focused ETFs. And then the other one, choose airline domicile ETFs. So my honest opinion here for investor, the primary selection factor is definitely not domicile when it comes to ETFs. So instead, it's really the strategy behind your investment and the index that you are tracking. So domicile does matter to some extent, but strategy matters so much more. And if you ask me personally, I have exposure to both actually US domicile and airline domicile ETFs, and the majority of my ETFs are actually US domicile. And if you ask me why, so the main reason is actually legacy, since I started my investment journey actually when I was in Hong Kong over 10 years ago already. And another reason is liquidity, so which is generally better for US domicile ETFs, like I just explained it as well, right? And now let's talk about currency exposure. So this one is actually often, misunderstood. So an ETF can trade in Swiss francs, but that doesn't mean you avoid currency risk. So what matters is actually the currency of the underlying assets. So for example, US stocks, you're exposed to USD. And if you invest in global stocks, multiple currencies. So currency risk isn't good or bad. It's just like something you must understand. And in order to avoid the currency risk, for example, if you want to invest in the US and you don't want USD, so you can choose currency hedged ETFs. But they're not always the best solution, to be very honest with you. And a lot of my students and clients, they come to me, they say, oh, I want to invest globally, but I don't like the currency exposure to yen, to USD, to euro, for example. And can I choose like Swiss franc hedged share? Of course you can. But here, I just want you to remind you that, these kind of currency hedged shares, they also come with downsides. And first downside is actually higher costs. So hedging isn't free. So most of the time you pay extra fees every single year. And secondly, it's about tracking difference. So hedged ETFs don't always follow the index perfectly, especially in some volatile market. And third, it's also about liquidity. So hedged share class has basically higher liquidity risk because fewer investors use them, right? And most long-term investors, they still prefer unhedged ETFs. So trading volume is smaller, so you have higher liquidity risk. So now let's talk about what are the popular ETFs for Swiss-based investors. And now let's get practical, okay? So when I say popular ETFs, I don't mean the best. I mean ETFs that Swiss-based investors commonly use as the building blocks. And these show up again and again and again because they're simple, they're liquid, and they're easy to integrate into a strategy. And the first one is global equity ETFs. And these are often the core of many portfolios. So basically, they give you exposure to diversified markets around the world, like US, Europe, Japan, and more emerging markets as well. And there are some popular examples. They track MSCI World or FTSE All World. And why people like them? So they have really broad diversification, they have simple structure, they're easy, long-term holding. So for investors with really long-term horizon, so this is often the backbone. And the second popular one is actually the US equity ETFs. You should know the US market plays a really important role in global growth. And many Swiss investors, they want direct exposure to US companies. And these ETFs usually track, S&P 500, total US stock market indices. And why they're popular, they have really strong liquidity, low cost, high transparency, Also, diversification. But you should remember, and this is US exposure and not global exposure. And the next one is Swiss market ETFs. Some investors, they like home bias. I would say, almost everyone more or less has a home bias, and that's okay sometimes. So Swiss ETFs actually track, for example, SMI or SPI, and they focus on some big Swiss names. For example, you may know, UBS, Roche, or, Nestle. And these ETFs are often used to balance global exposure or align with, for example, Swiss francs-based spending. And the next one is emerging market ETFs, and these actually add growth potential and also volatility. And they give you exposure to countries like China, India, Brazil, and they're actually a satellite, not the core. When I say satellite, they have higher risk, higher uncertainty, and long-term horizon required. And if we talk about the next popular one, actually bond ETF in recent years, they gain traction as well. Bonds still matter. So especially for medium-term goals, capital stability and reducing portfolio volatility. And Swiss investors, they often use, CHF bond ETFs or global bond ETFs. And these help smooth the ride a bit. Okay, and now let's talk about how I personally struck an ETF portfolio, and I will review the huge mistake people make here. And now the question drills down to, okay, Charlene, how to really construct an ETF portfolio? And is it the more the better, or vice versa? So this is actually where everything comes together. And this is actually where most people go wrong as well. Why are they going wrong? Because they start with ETFs. So we should know ETF is just a tool, it's not a strategy. And in terms of how I construct an ETF portfolio or the overall investment portfolio, so there are actually just a few steps. So step number one, you set the goals and the timeline. So before I touch any ETF, I ask one question: what is this money for? Is it really for early retirement, buying a property in 7 years, or financial freedom and flexibility? And when do I need the money? Like in 5 years or 10 years or 30 years? This step, my friend, is really non-negotiable. For example, same ETF, different goal, completely different outcome. Step number two is to understand your investment options. Really, beyond ETF. In the investment world, it's more than just, stocks and ETFs. There's so much more beyond that. And this is actually most people skip. So ETFs are great. I'm not saying they're rubbish, but they're not the only option. And depending on your goal and timeline, you should understand, for example, ETFs, stocks, bonds, mutual funds, cash, and pension accounts, and sometimes even real estate or other alternative assets. And not to use everything, but to choose intentionally. So ETFs are really powerful tools, but only when used in the right context. And step number three is about building the strategy. And now, only now basically do I build an ETF portfolio or the overall investment portfolio. And now I know my short-term, mid-term, long-term goal that I set in step number one, right? And I also understand different investment options beyond just ETF and stocks, in so many different asset classes and investment instruments that I just mentioned. So based on these two investment goals, your financial situation, and different investment options, build your investment strategy. So every ETF has a role, and nothing is random, my friend. So if you ask me what is the biggest mistake I see, Charlene, so I would say people really, they skip step number 1 and 2. They jump straight to which ETF should I buy. So in the end, they end up with, for example, 10 different ETFs, no structure, no strategy, no timeline. And basically, that's not investing, that is guessing. An ETF portfolio should tell a story, your story, and it needs to fit your investment goals. Okay, my friends, if this framework makes sense to you, but you're not sure how to apply it to your own situation, actually I've created a free investment training specifically for people living in Switzerland. So no finance background needed, no hype, just a clear system to help you start building wealth here in Switzerland. So the sign up link is below, so spots are really limited. So go grab it now, and I will see you in the free training.